Welcome to Do Something. I'm your host, Henying Fang. Today, we're diving into stock options, what they are, how they work, and how you can use them to your advantage. For a complete visual presentation, head over to our YouTube channel, Do Something, or simply search Stock Options Explained in 5 minutes. Let's get started. Stock options sound complicated, right? But what if I told you they're as simple as picking chicken or beef for dinner? Stick around for 5 minutes and I'll explain stock options in plain English and show you how to use them in the real world. Quick disclaimer, this is for fun and learning, not investment advice. Always consult a professional or do your own research before diving into the market. What are options? Let's start with the basics. An option is just a choice with flexibility. And having a choice, that's worth money. Let's say you buy a flight ticket you can reschedule. That's a real-world option. You are paying for the option to change your mind. In the stock market, buying options give you the right, but not the obligation, to buy or sell stocks at a set price by a certain date. For example, imagine you could lock in the price of chicken at $10 a pound for the next month. If prices go up to $12, you've got a great deal. If they drop to $8, you are not stuck. You just skip the deal. Flexibility has value, and in the stock market, people trade that value. How does the options market work? Options trading happens when two sides agree. The buyer pays a premium for the right to act. The seller collects the premium and takes on the obligation. It's like a movie ticket. The buyer, moviegoer, pays for a refundable ticket. They pay for the flexibility. The seller, theater, collects the money but takes on the risk of refunding if plans change. What makes options expensive? Option prices depend on 3 key factors. 1. Intrinsic value. Sounds fancy, but it's just the option's current worth. If a stock is $100 and your option lets you buy it at $95, your option is already worth $5. 2. Time to expiration. More time means higher price, just like an extended warranty. But remember, time works against you if you are holding options because their value decreases daily. 3. Volatility. The more unpredictable the stock, the more expensive the option. Stocks like Tesla or Bitcoin are more unpredictable than steady ones like Johnson & Johnson, so their options cost more. Other factors like supply and demand, interest rate, and dividends also play a role, but these 3 are the big ones. Learn the lingo. Before we jump into how options work in real life, let's break down some common terms you will hear when trading options. Here's a quick translation guide to help you follow along. Buyer example. Let's say you pay for the right to buy 200 shares of stock A by January 17, 2025 at $100 per share. Translation. You buy to open 2 contracts of a call option with a $100 strike price and January 17, 2025 expiration. Seller example. Now imagine you're selling that right to someone else and collecting money in return. You are giving them the right to buy your shares by January 17, 2025 at $100 per share. Translation. You sell to open 2 contracts of a call option with a $100 strike price and January 17, 2025 expiration. This lingo might sound technical at first, but don't worry, it's just shorthand for what we already covered. Keep this in mind as we look at real-world examples. How to use options in the real world. Options can work for you whether you are buying or selling. Let's explore 2 practical selling strategies. Use case 1. Want to buy stocks at a discount? Sell a put option. Let's say you want to buy 100 shares of Bitcoin ETF, FBTC, currently priced at $81.58. Instead of buying it outright, you could sell a put option with a strike price of $82 and collect $3.90 per share. Here is what could happen. If FBTC stays above 82, the option expires worthless, and you keep the $390 premium. If FBTC falls below 82, you buy the stocks, but your affected cost is $78.10 after accounting for the premium. It's a win-win. You either get paid to wait or buy at a discount. Use case 2. Want to lock in extra profits? Sell a call option. Now, suppose you own 100 shares of FBTC you bought at $60. It's now $81.58. You're happy with the profits but don't want to miss out if the price goes higher. Sell a call option with a strike price of $82 and receive $3.95 per share. Here's what could happen. If FBTC stays below 82, the option expires worthless. You keep the shares and the $395 premium. If FBTC rises above 82, you sell the stocks at 82 and lock in extra profits. Either way, you make money. So, what did we learn? Options are contracts that give you flexibility and control when used wisely. Whether you are looking to buy at a discount or lock in profits, they can be powerful tools. But remember, options are tools, not shortcuts. Manage your risk and stay informed. If you found this helpful, hit like, subscribe for more finance tips, and share this with a friend ready to master the markets. Happy investing! Until next time.